Mic check. 1 2 1 2. All right. Hopefully everyone can hear me. This is another guys, right? Another one, Amplify Trading, and I will be doing the advanced session with you guys tonight. Okay. Today is the 25th of July 2019. Right. Know a lot of people got paid, so probably the attendance is gonna be a bit slow, right? Or people are just gonna keep logging in 10 minutes into the session, 15 minutes. You know how it is. Okay. Um, but it's almost 8 p.m. right now, but we're a bit early, right, as we like to be. And so we're going to start off and kick things off. And I mean, the rest of the guys who got paid will actually just catch us in the middle of the session, guys. All right, so without wasting any further time, we're going to be looking at some brief markets. Right? I did have a few questions that hopefully I'll get the time to answer towards the end of the session tonight. And with that in mind, on that note, you guys can send me any questions that you might have on WhatsApp. Not that much on Telegram now, just so everything, just try and send it through on WhatsApp. And I will attempt to send through my analysis, okay, regularly. A lot of guys have been asking me to do that. I'll send through the longer term trades because a lot of guys get confused, especially about the short term ones, because some guys in the group, when they post stuff, they can be a bit vague in terms of whatever market that they're actually looking at. So let's just rather make sure that we're all on the same page on this. Okay. Right, so I'll give everyone about a minute to log in, and then we're actually going to officially start. Okay. Okay. Seems like I set up a different code. Let me just update that. Right. Let me resume recording. Everyone can see my screen. Just type Y if you can see it. Just type Y. Yes, yes, yes. Audio is good. If you do have any audio issues, okay, sometimes just use headphones, right, or just log out from the session and then log back in. Okay. All right. So won't waste any time. Everything you can get on the recording. I won't repeat that. You'll get on the recording. I'll upload the video on through to YouTube, right? It will be unlisted, so you'll have to use the link to actually get access to it. But I'll make it available for everyone to view that. Okay. So I mean, today was a very interesting day within the markets. Hopefully, you guys made some money, right? And there were some really good actual trade setups, right? So there were some decent setups, and what we're going to be doing today is going to be more of a follow-on from what we did on Tuesday with the advanced guys, right? Which is just using certain tools in line with what we look at when it comes to sort of like identifying liquidity within the market. Okay, so what we want to take note of is the key areas of where we're supposed to be buying and where we're supposed to be selling. Okay, because it's really irrelevant for you to follow religiously a particular strategy without understanding the real reason why it actually works. Right. So if you're going to have a certain methodology that you're actually following on a day-to-day basis, week to week, month to month, then you have to. It's imperative that you have a really clear understanding of why it works. That's basically why some strategies you might apply, okay, and it works wonderfully for you for a certain period of time, and then all of a sudden it stops working, and then you throw it away altogether. Okay. Now, to avoid that sort of stuff, what you want to do is to understand the reasoning behind a particular strategy and why it works, why it has a certain edge over other strategies within the market, and why it can potentially make you consistent profits. Okay, so now in a way, we have some very simple ways of actually looking at the market. Okay, so we don't like to complicate things. I mean, the market can either go up or it can go down. There aren't a million variables or a million outcomes that can come about within a market, right? So if the market opens at 24.84, the market can either close at 25.50, right, which is above 24.84, or it can close below 24.84, right, at the end of the day. Right, so it can go in one of two directions. However, as we all know, when the market is open and you are actually trading, it can feel like there are so many possibilities. The market can go up, can go down, can go sideways, can go left, can go right, in, out. So, I mean, when you're in the market on a day-to-day basis, you sort of like have this thing where you like plugged in and the market is taking you this direction and taking you that direction, and you change your view from being long to being short and watching those candles. So it can be really emotion driven. So the best way to take out a lot of that emotion is to keep your trading very simplified. Okay. Now, I did mention before that the first thing you have to do is you need to know strategy, right? Explain the strategy and why it actually works, right? So what we are looking for are liquidity areas, right? Looking at where the smart money is buying and where the smart money is actually selling, right? So where would those price levels be, right? Number one would be that a big figure, obviously, right? So those big figures, the round numbers, that's where a lot of the professional money is going to be coming in. Previous days high, previous days low, previous weeks high, previous weeks low, previous month or previous year's low. All of those areas will also form a bit of liquidity, right? So that's where the professional money is also going to come in. And what you want to do on a day-to-day basis is to isolate and view where the smart money is coming in and out. You don't need fancy tools for you to do that. Okay, you do need some logical thinking, because you're not going to be like, okay, boom, there's a big figure, right? There's a round number, 25.50, and that's where smart money is going to come in, right? So you have to build these sort of scenarios when it comes to trading the market. And an example that I can take you through at the current moment is this this GBP USD that we have in the 1 hour time frame. Okay, so you guys know I've been short on the GBP USD in terms of long-term view. Right. I haven't found any reasonable reason for me to be long. I'm pretty sure some of the guys who are in the sessions do know my view on this one. I actually did go short on the GBP USD, and I still have a long position on the USD JPY. Right, so those are my two positions that I'm still holding. The GBP USD is mainly because of what had happened at the weekly high. Okay, so this is where the market, this was the previous high of the week, right? Before these two candles, okay? Right, so now as we already mentioned, previous days high, previous days low, that is a very sort of like sensitive area where the market actually comes in and breaks above the previous high point, activating those buy stops above that area, right? So buy stops would have been clustered around this area here, right? So to help the market along, you can see that, and I did mention that I doubt the market would come back this week to around this high. Okay. Doesn't mean it's not a possibility, because it still can. While we're sleeping during the Asian session, the market can just come back to this high over here. So now, what you want to do, I mean, you have to look at the detail when it comes to something like this. This high was broken by a few pips, okay, and the market shifted away from that particular swing high. Now, what's interesting is the market came back to this area, right? Let's drop to the 30-minute time frame or the 15 minutes. Okay. Right. So now let's say, because what we're doing now is trying to understand, like playing around with these scenarios in your head. This is most likely if you were smart enough to actually see the move develop, you would have probably gotten in at 25.05. Okay, boom, market swings high of the week, and pulls back in. Boom. Right now, beginner mistake is as soon as the market gives you some pips, right, you start breaking even, don't you? Because you're scared of losing. So that's what most traders will start doing in the beginning. So the market moves in their favor about 40 pips, and then they take their stop loss and they put it in their right in front of their entry, right? Quote unquote protecting profits, but it's really hurting profits because if you had left this particular position open, right? If you had left this one open, you would have then made money, even if you didn't get 100 pips on the entire move. If you shorted here, and you would have at least got 50, right? Let's say 50, you weren't sharp enough to get out at 60, at least 50 pips, but now you ended up on plus 2 pips because of the nervousness that overcomes a lot of traders during the trading day. Right? So if you see here, we see two returns to this area, right, which tells us that there is potential for the market to shift in the opposite direction, because that's all the market really does on a day-to-day basis, right? Because the market is highly manipulated short-term. You've got these algorithms trading on a day-to-day basis. These large investment banks and companies, all they do is looking for short-term profits, right? So what's going to happen is there's going to be a lot of sideways movement, a lot of movement that may seem like it's disorganized, but it's really just orchestrated chaos, right? Organized chaos. So the shift away from this area, right, signifies, okay, we could potentially be heading for a downward move. That's coming off from the swing high, which formed the high of the week, and the market swings to the downside, boom, right? And then consolidates a bit, swings up, tags that 25.05 level again, and then swings lower one more time and starts consolidating. Now, this sideways consolidation, sideways movement, generally called congestion, drives traders crazy. Right? Nothing drives people crazy as much as markets that aren't moving. So, if, for example, you wanted to get short, you would, I could say, pull out your hair if you had any hair, but if, like me, bald, you probably just scratch your head. And that would be because there's a certain level of patience that people don't have in general. Now, people who become traders have to develop that patience, but as you sit there watching the markets go up and then go down, then you get another red and green candle, you start feeling a bit nervous, don't you? Especially if you're already, let's say, up 10 pips on the move, right? Say 10 pips. Let's say you were using one lot, right? 10 pips is like $100. And then the market moves against you like 6 pips, right? And now you're left with 4 pips. Now you only have $40. You're like, oh, I should have taken that. So it's very difficult to see your profits run, right? Getting 100, 300, 500 US dollars, and then waking up the next morning and you're on $20. It can be very painful. So that works against the normal retail trader whose thinking is sort of like average, because at this point, you shouldn't be even thinking about breaking in. At this point, what you should be looking at is maximizing the amount of profits that you can actually make, because you have to learn to make money being right 50% of the time. Because if you can make money being right 50% of the time, then you've got a chance. Right? If you want to be right most of the time, then you're going to really struggle when it comes to trading, because the markets can be random at times. Right? At times, mostly, you can see structure and it's going to play out. But it's all dependent on who's participating in the market at that particular point in time. Because the trade setup, like I said last night, a trade setup, you can find the perfect head and shoulders today on the Euro USD on the 1 hour time frame, and it can pay out. And then tomorrow you find the identical trade setup, the same exact trade setup, head and shoulder, 1 hour time frame, Euro USD, happen at the exact same time, and that one can lose you money, right? Simply because we don't know who is on the other side of the trade at that particular point in time. So if a certain bank that was there yesterday, let's say, isn't working today, so let's say Barclays is closed for the day, they're not trading, or whoever's managing money for that particular currency doesn't feel like trading, and there's a big company that pulls out on euros or just exchange a lot of euros, for example, to buy, I don't know, some land in Japan or something like that, then those things will often interfere with the outcome of the trade, because we're talking people who, or players who are extremely large, who can influence price change on a short-term scale, right? So price change is very sensitive on a short-term scale. Even one large investment bank can actually move price in one particular direction, but obviously in the long run, they need to be, all in for the price to move in a one direction. Okay, so in this instance, then you see the market move away from that swing high, which now is the new high of the week. Okay, now two things are guaranteed in every single market. There's going to be a high of the week, and there's going to be a low of the week. Okay, doesn't matter which market you look at what time of the year it is, but there's going to be a high of the week, and there's going to be a low of the week, right? So what then happens is, as the market moves away from the side of the week, what's comfortable to do is to just move your stop loss to break even, right? Boom, move stop loss, break even. The market comes in, tags that stop loss of yours, you go out with 2 pips, right? And then the market drops in your direction. Okay. Now, a lot of people don't feel that much pain, but I know I used to agonize over that because I lost money. Not in the sense that my stop loss was hit, but in the sense that I missed out on an opportunity to actually make money. Okay. So when you're right, you want to make money, and when you're wrong, you don't mind losing money because that's your business expense. So you get the sideways consolidation, the market pulls back up. Now, in general, you're going to have these pullbacks from these particular seemingly breakout points, these fake outs. The market will move about 25 to 30 pips on average in the opposite direction. Right. So if, for example, the market is, let me just get a chair. Okay, let's just say the market breaks below this low, right? You can see the market broke below the previous day's low here. Boom, activates the sell stops on the downside, and it moves about 19 pips. 19 pips to take out the stops. Now, also, you can see the swing high. If you manage to chase the move on the upside, buying the GBP USD yesterday, the market pulled back on average 25 pips before it moved the intended direction. Okay, same thing almost all the time. So if you caught this move, let's say you were chasing this move on the upside, the market then pulled back about 27 pips and then push to the upside. So if you go back, you can go back as far as you want to. And what you're trying to do is you're trying to look at where potential breakouts could be, right? So this could have been a potential breakout, right? If you had sold right below this close, the market first pulled back about between 25 to 30 pips, boom, before pulling back down. You can see again, this happened second time. Market gave us what seemed like a breakout to the downside and then pulled back exactly 26 pips and pushed down again, right? Same thing over and over again. So swing low, market push back. This was an extended one, 40 pips in total, and then pull that down, and the breakout here is also a bit extended, so I think about 40 pips in total. Okay, so you had a breakout here, market pushed up about 35 to 40 pips. So understanding that there's something of the sort within the market can actually help us there, because what we want to do is we want to be able to spot that, identify it, and then from there take that piece of information and make it work for us. Okay, so once we see that that has occurred, right, it's added confirmation that you are in the right trend direction of bias, right? So every time I used to do it like this, okay? You guys can do it a different way. But if the market pulls back into an area where I would have had my stop, I wouldn't take the trade, right? This one, but I'd wait and look at if I had a trade here on the sell side at 25.05, then I would have been thinking about breaking even now, right? So if that were the case, then I'd place a trade with a very tight stop, about 10-15 pips, right where my break-even stop would have been. Okay, but or if I had the trade already on, let's say I have one standard contract at 25.05. What I'd do is I would break even, but I'd also put a sell stop just before that stop loss of mine. So the market would activate the stop loss, and the stop loss would actually be a bit bigger than the normal one contract. So I'd go like 2 lots or like 4 lots at most, and then have a very tight stop loss on it. Because in most cases, if you get the market pulling back into an area, let's say you were going to be a buyer at or seller at, I'd say this also is an example, some sort of an example here. Let's just go to that. Okay, so something along these lines. So you have this high, right? And if you sold at this low, at this area here, right, naturally you'd want to break even as soon as possible. And once the market starts moving away, that's what you would have done naturally. And the market comes back in to that area, right, dips into that liquidity, and also takes that stop loss that you had at plus 2 pips, and then started shifting away again, right? And for all the smart guys who got in on the move on the downside here, boom, market comes back, does the exact same thing, swing high, and the market drops to the downside. This is too easy, guys, to actually spot. It's easy. The actual difficult part is managing sort of like your emotions throughout the entire process, because this happens all the time. You get a buy and your trend direction is right, the market goes higher, you take your stop loss, you put it right where your entry was, the market comes back, boom, takes out your stop loss, right, your break-even stop, and then moves in your intended direction anyway. Okay, so with that being said, we're looking at, right, this being a confirmation for us to be in the trade, or to rather stay in the trade if we're already in the trade, because that means that more likely than not, we are actually in the right direction, and someone just wants to assume the position we have. Because if you sell here and the market, and you break even stop, you put it there, and what happens is someone has that position set up. Okay, let's say you get smart money, okay, boom, right there, the break even stop at 25.04, market comes back into that 25.04 area, and what do? Right, get out on the sell side, which means you buy back the short position that you actually had. Now, if you are buying here, someone has to sell to you, right? And obviously, that's what smart money does. So they sort of like take on the position that you have. So if you had one started contract, whoever now has actually sold to you is now holding the profitable position that obviously would have been yours. Okay, I hope I'm making sense. So with that being said, what you want to do is you want to be able to see visually how the market behaves, but also on a mental space where you can sort of like play around with the scenario in your head. Because when you're looking at the charts themselves, I mean, this is very easy to see. You don't need any fancy charting to actually see that. Now, it does help, obviously, okay, because some people are different. It would work better if they have a semi-automated system whereby it actually places the trades and they just manage them. Some people would be better placing the trade than having an automated system manage it, or all of these different things. So it's all about just adjusting whatever is going to be good for you. But this is all that it is, right? In terms of looking at where the market is, this is on a day-to-day basis, right? So you're talking short-term price action here, and that really is something that we should learn to understand and should learn to relate to when it comes to the charts, right? So something you should be able to spot easier and easier as time goes by. Okay, guys, got any questions? I start my webinar. Okay, guys can still hear me? Sorry about that. Okay, guys got any questions? Any questions from your side? Okay, no questions? None whatsoever? Okay, all right, so if you guys don't have any questions at the moment, all right, if you do have any questions later on, you can just send them through to me on WhatsApp. And I think our next session, I'll announce the next session because I just wanted to do some extra or some additional stuff later on during the course of the weekend, but I'll need to find out what time I'm gonna be able to make it. But I will make that announcement in the group before the end of day Friday. Okay, tomorrow that is. Okay, so yeah, I'm pretty sure that everyone is good then. We'll be uploading this. I just need to check a few things with the actual recording before I upload it because I mean there was a lot of spaces, so I might have to chop that out. Where it was just quiet because I sent through the wrong code. Yeah, but I'll check that and then upload it and then send through the link in the WhatsApp group. Okay. All right. So yeah, for all the guys who've been asking about the copycat trading, I guess I'll have to do some sort of a PDF or something along those lines, where everyone can just read and understand a bit better about what that actually is. Okay, because it seems like some people don't understand the actual concept of it. So I'll just we'll have to get documents done, some sort of a PDF, and that's actually going to explain how the process is actually done and what are the benefits of that. I'm pretty sure if there are any other guys who are in the copycat trading system today, we are up a bit, right? We are. Today was an okay day, and obviously, I mean, the main objective is to actually make profit. So I think today, and I think yesterday as well, most of the accounts were up. So yeah, if you want to inquire about that, I'll get a document together probably tomorrow or Saturday because I'm just bad with the paperwork and stuff. So I'll get that ready so you guys can understand that a bit. But for now, okay, just practice checking out these markets, right? So just the main thing is just trying to understand or trying to make sense of these key liquidity areas. That's the most important part. So previous days high, previous days low, just highlight those and look at how, well, that's the most important part. Realizing that the markets have a particular pattern most of the time, not all the time. Okay, it might be 60%, might be 70, it might be 80. Just know that you only need to be right, even 40% of the time being right. I mean, Warren Buffett is right about 30% of the time. Okay, it's just that 30% of the time he is right, he makes a lot of money. So that's the kind of thinking we need to adopt in a way, right? But obviously, we'd like to be right a bit more than 30% of the time. Okay, if guys don't have any questions, I'll end off tonight's session here. Have a great evening, guys, and I will chat to you soon. Cheers.